investing strategy. Looking across the globe, where is he finding new investment ideas? Here to help us take a look at the global equities picture heading into 2025 is portfolio manager Patrice Quirion. Nice to see you, Patrice.
Good to see you.
I'm glad you could join us here and join everyone here, and we'll ask people to send questions in over the next half hour or so for you. Let's begin with what you see in the markets as being these big headlines and how you ultimately react to them. You're watching them just like everybody else.
Mm-hmm. Yeah, obviously, since the U.S. election, there's been like an increasing number of those headlines. I think that notion of tariffs is certainly front and center. And it's moving the markets in a pretty big way. And it's really in my opinion, adding fuel to the fire to a trend that was already quite powerful even prior to the election, of that U.S. exceptionalism,
right.
Really like gathering a lot of the momentum in terms of investor flow, investor sentiment, valuations that are, in my opinion, like getting increasingly expensive in the U.S. versus the rest of the world. And
it's consensus. I mean, this is consensus.
It is very consensus, and the U.S. election, I think, literally added sort of more room or more fuel to that fire to go further. I think it's important to step back a little bit, and at least in my investment process, which is trying to scout the world, look where can we find good businesses that are trading on very reasonable prices, where our optics of long-term rates of return should be favorable. We screen through hundreds / thousands of companies. And increasingly over the past like few years, looking at those like very much on like a fair value, what do we need to believe in to compound our capital sort of 10, 11, 12% over time? What sort of assumptions do we need to bake in? And where do we find those? It was already becoming more difficult to find these ideas in the majority of the US market.
Like over the course of sort of watching this broadening that we've been discussing for, the last 6 to 8 months.
Yeah.
Will it come? And then it did come.
Yeah, absolutely. I think initially, if we rewind the clock, like more or less a year, it was like a very narrow market where you could still find like pockets of interestingly valued companies in the US. Maybe not like in the Magnificent Seven or like high momentum growth or super high quality companies that the market was chasing. But we did get this broadening, especially post-election, that broadening like really accelerated. And now it leaves us at this sort of difficult juncture where most of the market looks to be embedding like very optimistic expectations of US continued like outperformance, US dollar strength, lower tax rates, like domestic boom from like benefiting from reshoring. And the reality is to underwrite that as your base case, I think, at least in my process, is becoming increasingly difficult. You need to believe in a lot of very optimistic scenarios playing out to say like a lot of these stocks are still really interesting here. And the interesting dichotomy as you look across the rest of the globe, and I really emphasize the rest of the globe, like I
anywhere else.
A year ago, it was maybe more like China specific. Like maybe 2 years ago, it was a little bit more Europe specific. No, it's everywhere. Like all of Asia, all of emerging markets, all of Europe, like Canada and that, it is looking like very differently valued. What you need to believe in is much less rosy. And I think that leaves a better risk reward from here. Not only from a valuation standpoint, which is just obvious. You look at the valuation on forward earnings of the S&P 500 versus the rest of the globe, and we're getting close to like a 2-to-1 kind of ratio, which is totally out of whack with history. But then it's not only valuation, it's fundamentals as well. We all know fundamentals in the U.S. have been superior over the past number of years. But what matters to the market is not like just this absolute level, is trajectory, is like revision to expectations. Can you surpass the bar that's been set? And look, it is very much case by case, but in aggregate, expectations on the US corporate profitability in terms of like profit margins, in terms of like organic revenue growth rates, are becoming like elevated.
Right.
And you don't face these same like as elevated like expectations on companies again like across the rest of the globe, which I think opens the door for, can't promise when, but at some point if you get the rosy scenario sort of being missed around like the resilience or reacceleration of the US economy, or if you get the dire scenario of take China, maybe at the margin improving and doing better than expected, I think the valuation gap opens the potential for like a very significant move the other way.
So your funds, so you've got global and international, one will include the US, and you're saying you're looking, well, you look everywhere, you'll look at the US, less and less attractive valuations basically in the US. So the international takes over, and looking everywhere sort of outside of the US.
Yeah.
Where are you looking right now?
Maybe just to contrast the two portfolios. So I have an international fund which excludes North America, and a global fund there, which allows me to go everywhere, including the US. The US or North America is now about 70% of the world's market cap. So that sort of view or that expression of the ability to find better priced companies where they are more in line or discounted to their fair value has really been easier to do in international markets. And as a result, even the global fund is increasingly looking more like an international fund. The underweight in the US is now over 30%.
Wow.
So there's still an element, we're still finding like ideas here and there, but increasingly difficult. So where are we looking elsewhere? That's been changing over the past few years. A couple years ago, it was much more in Europe, maybe a short phase where Japan had interesting ideas. For the past, like I would say since the beginning of 2024, I think China was bringing a lot more of these ideas. And a little bit to my point earlier, now it seems pretty broadly generalized, where I wouldn't say there's like one region that seems like massively more discounted than another one. So it's really like back to what we always do, focusing like company by company, trying to understand the fundamentals, trying to understand what are the expectations, where do we have a different view on expectations potentially being too low on terms of what's priced in by the market, and going there.
So you're talking about, I mean, on top of everything else, these will be companies in countries where there's a currency offset, a devaluation essentially against the US dollar because it is so strong right now. Mm-hmm. Just walk us through why that's going to be attractive.
Yeah, so the currency has taken sort of a front and center role post-election, given the tariff like threat that's overhanging here. And obviously, if we see like massive tariffs, not only like on China, but on European goods, on Canadian goods, on Mexican goods going into the US, the currencies will need to adjust. And there is a likelihood that this happens. We can come back on like, sure, is that a given or not? So there's probably a lot of negotiation or negotiating tactics deployed right now. But the market took the view that there is a decent likelihood that this happens, and we've already seen currency moving to keep the relative competitiveness of different parts of the world. Essentially, the currencies will do a good part of the work to offset the impact of tariffs. So how does that bring opportunities? I think to simply say, I will buy, I don't know, let's give an example, Mexican industrial production exposure that sells in the US because the Mexican peso will devalue or as devalued. Well, this is risky because like obviously the tariffs will offset some of that. Where my focus is at the moment is much more trying to find the companies where they are in a geography where the currency has depreciated, so their cost base in US dollar terms has come down.
Right.
Companies where they do sell in a market that's typically priced in US dollars, but where it is not necessarily all going to the United States. So for instance, to give a few examples about that, let's take aerospace as a sector. There's two big poles. There's like the Boeing pole in the US, there's the Airbus pole in Europe. And this is a market that it doesn't matter if you sell your aircraft like in emerging markets in China, in Europe, or in the United States, it's always priced in US dollars. a lot of the market is actually not the United States. Like think of the aircraft like or tourism like development in terms of industry in a lot of emerging markets requiring a lot of new aircraft going there. So if you can find these companies that have like a cost base which is increasingly competitive, selling in US dollars and not impacted by tariffs, this can lead to something that maybe people are not thinking, like in aggregate it's not the case, but there's those examples where companies might be net beneficiaries of that. Think of companies selling, I don't know, like consumer goods, mostly like to China, which is, okay, we can question like the magnitude of the peg, but there's still like an element of
there's a
peg to the US dollar. That Chinese consumer should be relatively unimpacted by like tariffs in the US. So there's all sort of like those, I would call it like second degree thinking of it's maybe not all that negative. Like to give another example, here it's maybe not like a net benefit, but a lesser negative than maybe what the market is thinking about right now. Like front and center is probably the auto industry where like tariffs is a big impact. And I think a lot of the market reaction is to say, well, US car makers will be favored, and if you're like a European or a Japanese car maker, like this is big trouble ahead. And when you really do the work, and I'm not saying this is necessarily where we're invested right now, but if you do the work and look at, like, for instance, there's one of those German car makers, which is a net exporter out of the US. One of the most domestically, like, focused in the United States in terms of like local production for local sales is actually a Japanese company. And then you look at the US car makers, and a lot of them actually do use Mexico, do use Canada into a pretty substantial way. So the market reacts on like what seems like the right thing to do initially, but there's always this opportunity with our research team to do the work and find those anomalies and ask yourself, is that creating like an interesting like entry point on something that is counter to the general thinking?
So that's fascinating, and it takes us, you've already been sort of talking pieces of this, but the story of deglobalization, of this era of friendshoring, of getting these right. So this is happening, we're watching it happen. The tariffs are expected to increase it. That said, will it be, do you think, as sort of broad or widespread as is currently being discussed?
I am a skeptic on the ability to move back maybe as many industries as what the ambition is politically, or even if it's not an ambition, I think it's certainly a messaging and what's creating fears in the market. I think, and look, we have a little bit of a playbook of what happened into the first term, like from 2016 to 2020, like there were some tariffs imposed. Maybe to touch on that for a moment, the tariffs that were ultimately exposed were really watered down, were negotiated away. I think there's an element of posturing right now. I doubt that the tariffs that we are seeing as like making the headlines right now is really what's going to be ultimately implemented and have in terms of impact. But let's come back to what does it mean to US reshoring. I think ultimately there are some really strategic, value-added, like critical industries where there is a real like force trying to reshore those. Think of semiconductors, I think is really on top of that list. There's other industries that are taught to be on top of the list. I don't know, like batteries for electric vehicles or like grid backup power, etc., where it might be more challenging than maybe what it looks like at the surface. But then you go into a lot of other imported goods, and I think the reality is it will end up truly being a tax on the consumer. Everything that's commodity related, you cannot reshore that. Commodities are where they are.
Where they are.
A lot of like lower value added,
like
sort
lots
of
of
labor
plasticky
intensive
things that you buy from China that are, fill your home and
totally.
is that all going to be reshored?
I highly doubt it. Textiles is like a big industry, like very unlikely to be reshored. So I think this is more a tax on the consumer. And look, ultimately, there's a limited capacity to produce all of that in the US. And I think it is actually true for a fair bit of what is made in Canada. Most of our exports to the US are commodities, and that's not really going to change. A lot of what is made in Southeast Asia or China or India are like those lower like value items that are very unlikely to move back to the US. What is moving back is those more strategic industries. And for semiconductor, it makes sense.
Right.
But you need the help of like the global leaders in those industries. So although we are reshoring semiconductors in the US, like who are the companies owning those assets? TSMC is building some of those plants, so the Taiwanese company. Samsung is building some of those plants. And then if you think about like battery, which is maybe like another key industry, the reality is like a company like CATL, the big Chinese like battery global leader, like by a mile, is likely to be the company like owning those assets down the road. So it's much more complex than just saying this will bring everything back to the US.
Okay, so interesting. You've painted the picture of where some of the other opportunities might be so well. Let's take a little bit of a look back at the US exceptionalism case. Some of what's built into the valuations is, well, the exceptionalism, also a huge amount of capex. There's been a cycle going on. We know this. We haven't even mentioned interest rates. Maybe we'll talk about that in a second. But just come back to sort of the valuations that you're up against in the US versus everywhere else that has good ideas.
Yeah. The valuations is pretty straightforward. Anyone can pull a chart and look that the S&P 500 is now on like 22, 23 times forward earnings versus the rest of the world now on like 12, 13 times earnings. But obviously, as long as the earnings outperformance continues, to just simply make a case that the rest of the world will eventually catch up, like, is a little bit more challenging, or certainly more challenging to call like when or what could create that inflection point.
Does the rest of the world have to catch up or just get a bit better?
I'm in the camp where the biggest move, like what the inflection points create the biggest moves, usually from low base or from very high base on the other side, can happen very quickly. It's not always easy to know like what will be that catalyst to that inflection point. But when you get like very extreme, very crowded or like left behind areas, like that likelihood increases. I don't have perfect visibility. I don't think anyone does on what will create that inflection point, but there's a few things that comes to mind. I think you need to have a view that this inflection point will likely reflect in some sense earnings outlook, maybe being less of an outperformance of the US and maybe less of a drag for the rest of the world. Okay. And then you start dissecting like what has caused that pretty broad divergence in earnings expectations being on different trajectories. Right. And I think it has partly to do with sector composition, where the US market is heavier in the big tech names, which have had like a ton of earnings momentum. The bar is high, so could it come down to the first quarter that one of like the leading like semiconductor company like was to miss expectations? That I think could have consequences to have maybe investors revisit expectation, revisit maybe weights and capital allocated to parts of the market that are elevated. And could that be sort of the starting mechanism to move capital to elsewhere and just the relative market caps? Like if you need to move money out of a sector that has become like extremely heavy and recycle that in other parts of the market, it can have meaningful implications. So that would be more maybe from like a negative to like a big US earnings driver. Right. Could it be stimulus out of China that starts to, can we start to see signs of that eventually working, bringing back consumer confidence, bringing back consumer spending, and maybe changing a little bit that more depressed view of like future earnings outlook for Chinese companies that could bring like capital to flow back to the region and need to be funded from elsewhere. So those are like maybe two, or it could be something that we're totally not seeing today. We don't know.
What about Europe? Is it so much a catalyst story, or are those? I mean, it strikes me that European companies sort of hum along, but you've got the currency, the devaluation, and the exceptionalism there.
Yeah. So Europe, I think if we rewind the clock a few years back, you could still find a fair number of like companies that just look way too cheap. And to my portfolios, I expressed that in a fairly meaningful way through the European banks at the time. I think a lot of that has re-rated somewhat. But I think my general message is it's not necessarily that the rest of the world has this like massively underestimated like broad opportunity. I don't think we're at the stage where putting your money in Europe, like you'll double your money over the next years. I think there are some mispriced opportunities here and there, but is the market generally like dramatically mispriced? Probably not. But if there are some investors who share my view that in aggregate, the markets are expensive, maybe more at risk from this, call it midterm perspective. If you can find like an adequately priced, decent company that will continue to grow with its sort of compounding algorithm of 10, 12%, which is what we tend to, or what I tend to search for, and you can get it at a very reasonable price on very reasonable expectations, I think that increasingly makes sense to have these in a portfolio as opposed to chasing the flavor of the day that will double your money like next quarter. I think this is becoming a dangerous game to play. And I'm finding more of those in Europe and in the rest of the world in general.
So there's a great question about Canadian sectors. I just want to follow up on whether you actually see sort of a leadership change. I mean, U.S. exceptionalism is very strong. It's consensus. It's one of the first things you said. Do you see that change?
I think at some point it will. Do I have like insight today to catalysts that will make it change? Truthfully, I don't. I think the excess is to the point where it becomes risky to keep sort of allocating more and more capital there. Just a few stats. You look at retail investor sentiment, very close to all-time high.
Yes.
This is like from a U.S. lens, by the way. You look at money flows by geography. Like basically Europe, the rest of the world has been like in pretty steady outflow. And where is that money going? It's going into the U.S. stock market. Valuations that are high, earnings expectations that are probably more elevated versus not. In my view, it doesn't create like a great sort of risk-reward profile longer term.
Sure.
And at some point it will turn, is my view, and not necessarily based on a view of, is that turning like next week or next month or next year?
So here's a question. Do you think, based on a lot of the things that we're talking about, do you think that basically tariffs, do you think that some Canadian sectors might reposition to Europe and Asia for trade? It's a bit of an age-old question, but is this a new time to reconsider?
I think where possible, we will likely try to do so. But the reality, it's a little bit like the US story, where it's really hard to envisage a scenario where suddenly like all of that imported goods, like those relationships break down and it gets manufactured in the US.
Right.
It's a little bit the same thing for Canadian exports. The reality is most of what we produce will continue to flow to the US. But it does put pressure on governments and on companies trying to build those relationships to ship elsewhere. But is it going to move the needle? I tend to be more skeptical on our ability. Maybe for commodities, can we try to move more of that to other markets? But it already sort of is going there. Those are, a lot of these are truly global markets, and especially for commodities, the price gets set globally. It doesn't really matter if you export it to the US or to Europe or to Asia. So no, I would be careful of thinking Canada or Mexico as that like golden opportunity to just
go elsewhere.
Right. I don't think those trade flows will change as much as what the market makes it to be outside of those strategic industries.
It was interesting to go back to China. It was interesting to see when that stimulus was issued, because there were great calls for it all year. It was almost like a desperation by the time they applied it. With that said, what does it do to sort of to the economy, but almost to the consumer confidence piece of the economy?
That's a missing piece in China. Is the government's trying hard to turn around corporate confidence, consumer confidence. Savings rates are incredibly high. The willingness to spend is very low because of that lack of confidence. And what needs to take place for that is, I think, signs that the government tries to put a floor on real estate. And that will also...
Do you expect that?
As much as I'm not a believer that we will see like a sustained rebound on real estate, because that's not what they need.
No.
I think measures can be put in place to stabilize pricing And this is probably more important than sort of reaccelerating real estate or infrastructure construction activity per se. This is like already massively down. I don't think the prospects are that great to reaccelerate that. So if we think about, I express that into the portfolios, I am overweight on China since a while, especially over the past year, but even prior to that. And it's really expressed through the consumer lens. So that view on...
To the domestic economy?
Yes, the view that the consumer has the ability to spend like excess savings that have been built, like excessively high like savings rates right now, from a turn in confidence. Again, like a lot of my investment style is not catalyst driven. I don't invest there thinking, oh, next week we will have that great big stimulus that the markets are waiting for. It's very much on a long-term view, like what seems overly discounted versus its fair value versus its earnings power, its potential. And I'm finding a lot of these, especially in consumer-related industries, and especially tied to the Chinese consumer at the moment. So this is where it's expressed. But there are other pockets of opportunities. Let's go back to sort of market generalization. I think there's that view. Chinese exporters are going to be in trouble because of the US market's going to close to them. We discussed it might not be as much the case. I think there's another really important element actually that's not talked about much is increasingly a lot of these exporters, mostly out of China, but it's not only China. There's some in Southeast Asia. There's a little bit in India as well, but mostly China, are basically on the roadway, on the path to slowly and surely like taking market share away from Western multinationals and emerging markets. So the reality is you may think, well, let's go back to 2016, like first round of tariffs, like austerity, trade war. What happened to, let's take the example of China because that's the country that matters most. Chinese exports have way outpaced exports from any other country.
Even during tariffs.
Even during tariffs, in part because the US story has kept importing, despite tariffs. There's been exception, obviously some categories have been hit and others have kept growing, but mostly because they are taking a lot of market share, exporting through Southeast Asia, through Africa, the Middle East, LATAM, even Europe to some extent. And the product quality has improved. The price gap is still very, very wide. They now have like some global leaders, like think of like TikTok and Shein that like brings more visibility or platform to distribute that. They've built the infrastructure with the Belt and Road over time. So it's not all as negative as what the market maybe portrays it to be. And this is what I'm looking for, essentially as like a contrarian investor is, let's go look where expectations are really low, valuations are very compelling, and where maybe there's an angle that we can get like a handle on that's differentiated than the general view.
This is fascinating, and as you say, it's sort of the second degree of thinking because we're still in that first degree. Very glad to have a chance to talk to you about this. Patrice, thanks for joining us.
Pleasure to be here.